Good afternoon, Marshall Reddick clients and investors. We are so excited to have you here with us this evening for our private financing webinar entitled Use Private Financing to Build Your Rental Portfolio. We're so excited to have you on. Some of you are longtime seasoned investors and clients. Some of you are brand new to us here at Marshall Reddick Real Estate. Nonetheless, we really do appreciate you joining us tonight. Being on this webinar, utilizing one of the great aspects of Marshall Reddick Real Estate, and that's the free education. A little bit about myself. My name is Daniel. I'm a realtor and an advisor here at Marshall Reddick Real Estate. I've been here for 3 years now. Many of you I've gotten to know today on my calls and I've spoken to before. Some of you I'm just getting to know for the first time, but nonetheless, really excited to be hosting this webinar tonight along with our Vice President of Private Lending, Patrick Prunty, who will be introducing in just a moment. A little side note, this afternoon I'll be getting things started, but I am taking off to do a couple showings this afternoon, but I'll leave you in good hands with, again, the VP of Private Lending, Patrick. For you first-timers and newcomers here tonight, a little bit about Marshall Reddick Real Estate. We've actually been in business since 1979, and anything in regards to residential real estate, we can help you with. There are 3 primary divisions that we have here at Marshall Reddick Real Estate. First and foremost, our brokerage. As a realtor and advisor, I work with clients directly and helping them evaluate markets, analyze investment opportunities, buy and sell residential real estate. We also have our property management division. In any one of our 16 markets, we have carefully vetted professional and experienced property managers who can help take care of your assets and your investment portfolio. Last but not least, and the department we're talking about today is our private financing division. We'll be discussing in more detail how you can use private financing to build your investment portfolio. We'll primarily be talking about borrowing private financing, but one of the really great things about Marshall Reddick Real Estate is that you can actually lend your funds and collect a passive return. So it's important to note that the individuals who are lending their funds, the source of the capital that you would be borrowing if you were utilizing private financing to acquire real estate, the source of that capital are actually other Marshall Reddick clients, just like you.
Yeah, thanks so much, Daniel. Patrick Prunty here, pleasure to be with you guys. There's something really special that Marshall Reddick offers. Although we're going to be primarily focusing tonight to you guys on the borrow aspect of things, as Daniel mentioned, all of the capital that's being utilized in this program is coming from private Marshall Reddick investors who probably have owned and purchased rental property through us over the years, but are trying something new that we also offer. Perfect for your IRA or 401k, which is very popular and which we're going to touch on tonight, but also fine for cash or savings, or perhaps you're a little nervous about what the stock market's going to do and things of that nature. So just know that we do offer that as an investment option as well.
Yeah, thank you so much, Patrick. Really helpful. And one additional thing that we'd like you all to know before we really dive into the presentation tonight, especially as your advisor here at Marshall Reddick Real Estate, I want to highlight that whenever possible, it's really going to make the most financial sense to utilize conventional financing. You'll see the lowest down payments and the lowest interest rates. But like we'll discuss tonight, there are plenty of situations where investors cannot utilize a conventional loan to leverage their investment property. And so the next best avenue is really private financing. And we're so excited to be able to offer this program here at Marshall Reddick Real Estate.
Yeah, awesome. Good news. I'm glad you're able to join us for at least a little bit here tonight, Daniel. It's such a wealth of information. So as you mentioned, my name is Patrick Prunty, and I run the private lending division here. That's for both the borrower and the lender side, the senior team member, and it's just been a really fun ride. I just had my 15th anniversary, and it's shocking to say that I've been with Marshall Reddick for that period of time. I have utilized most of the Marshall Reddick resources to build my portfolio, and I've done it a lot with private financing on the acquisition side for rental property, but I also do a lot of the loans, both short-term and long-term. So, you know, again, investment property owner and private lender, I want to share that knowledge with you. Additionally, I have a self-directed IRA with the Checkbook LLC arm, and I have quite a bit of experience with that on both the tax side and how that works with the IRS and with the CPA, but also from an investment perspective. So a lot of people come to me and we have consultations and we sit down and we talk about how to utilize that retirement account to really leverage yourself to some long-term wealth.
All right, now that introductions are done, that leads us to our first poll this evening. Keep in mind, these are completely anonymous, but really help us to gauge our audience and share the most important and pertinent information. So first question tonight, do you have a self-directed retirement account? Few different answers to choose from. Yes, no, but I'd like to help setting one up.
So we'll just give a couple of minutes. We really appreciate crowd participation, you guys. It's interactive and it gets you all involved. So take a few seconds more. We're getting a good turnout. We'll give just a few more seconds there, and then we're going to close the poll. We're going to publish the results. It's a cool part about this program. You guys can actually see what your peers and counterparts on the call have to say. Okay, so we are going to go ahead and close the poll and share the results.
All right, and it looks like almost half of you already have your self-directed retirement account. That's great, but for those of you who do not have your self-directed retirement account set up yet, Patrick and I, great resources to help begin that process and utilize those accounts and those funds to further invest in real estate and in our private lending program. And one really important individual with whom both Patrick and I can get you connected is Dmitry Fomochenko at Sense Financial Services. Dmitry is actually a former employee of Marshall Reddick, started with us many years ago, went off and started this company helping his clients invest with their self-directed retirement accounts.
Yeah, Dimitri is just a super wealth of information. So I'm a huge advocate. He helped me set up my self-directed IRA. Geez, been almost 10 years ago now. And I have bought rental property inside of it. I've used non-recourse financing like we're going to be talking about tonight inside of it. So I understand how all that works. And I always go back to Dimitri because there's so many niche and individual type questions, right? You don't necessarily need to use a service provider like Dimitri if you're just going to set up a self-directed IRA at the custodian level. But if you do want to add that checkbook arm, or if you're able to qualify and can set up a solo 401k, which is a much more superior self-directed retirement, you need to work with a professional such as Dimitri. Okay, so I encourage you to utilize him as a resource, as a part of your education. All right. Well, Daniel, I think you got to get out of here. I appreciate you being here tonight.
Yeah, thank you so much, Patrick, for having me, and thank you all for joining us tonight. You're in for a real treat and a wealth of information. Have a great evening. Thank you.
Okay, awesome, guys. We're just going to move right along. We've got a great educational webinar going, so I want to spend as much time on the content as possible. All right, so the goals for tonight's program. We're going to be talking about the private financing that we offer, right? Hooray, Marshall Reddick offers it. There was such a demand from our clientele, and it was just a service that we did not offer, right? And that service comes from both, again, both the borrow side and the lend side, We're also going to be talking the differences between conventional, also known as conforming financing, versus private financing. And that segues into when to use private financing. When is it appropriate? We actually have a long-time client on the call tonight who did a private loan just like this, like we'll be talking about tonight. He's a real estate agent, so self-employed, doesn't, has a lot of write-offs, not able to qualify under the conventional guidelines. And so we're going to kind of dive into those details, but that's very cool to see returning clientele on our presentation. We're also going to be talking tonight about the loan programs, the actual individual programs, and the details that we offer. And then lastly, we'll talk about the ins and outs of how things work. Okay, so a private financing, first and foremost, non-owner occupied only and residential real estate only. So no, a lot of people want to get into their primary residence, buy something distressed, use private money, and then refinance out conventionally. Unfortunately, we're not equipped to do that. So investment properties only. As far as residential real estate, multifamily is okay, right? A conventional lender is only going to be able to go up to say 1 to 4 units, but we're able to go up to say 15, 20 units. We don't play a lot in that space. Usually it's single families and small multi-units, but it's not a guideline deal breaker. So we still consider residential real estate as long as it can be occupied and rented, like a living capacity. As far as strip malls or research and design or things of that nature, those types of programs are completely out. Programs we'll be talking about tonight are available for purchase money loans, for refinance, or for cash out refinance, right? It's a very popular model being used by a lot of investors. They pay cash for property, right? And they're maybe buying it distressed and fixing it up, but they want to hold it. But instead of keeping their cash all in the deal, they want to borrow against the asset that they own free and clear, that's stabilized and will, appraise for a good price now after the renovation. So I have a lot of folks coming to me to do those cash out refinances. Okay, so that is something to keep in mind. So all three are on the table. Non-recourse option, huge, right? Self-directed retirement accounts are very popular today, and banks simply do not make, or most banks, I should say, do not make non-recourse loans. They simply don't know what it is. We're not a bank, though. That's an important thing to know. Marshall Reddick's a private lending institution, or has a private lending arm. And there actually are a couple of banks out there in the country, namely North American Savings Bank and also First Western, who are more the institutional lenders who play in the non-recourse space. Okay, so this is a screen clip on there about, it's kind of a joke, but, the bank, what do, right? They take deposits and they literally pay 0%, or in this case, 1.16% on your money, and they're able to lend it out very cheaply. Now, I bring that up, and I bring up the fact that we're not a bank is because we can't compete with banks in terms of interest rates. Now, our interest rates are not ungodly high, but they're not going to be able to compete with the NASBs that are, let's say, lending out at about 6% or so today. Now, we're getting a lot of overflow business from NASB, and the problem is because they're a bank, they're a huge bureaucracy, and they're very slow. So as we get in the presentation, value customer service and they value speed, and that is the niche, that program that Marshall Reddick can fill for you. Okay, let's talk non-recourse. So although we have a lot of sophisticated folks on the call tonight, we may have some that aren't as sophisticated. So a non-recourse loan is required if you're going to borrow money as a 401k or an IRA. And banks do not make, or traditional lending institutions do not make, non-recourse loans. What actually is a non-recourse loan? Well, simply put, there is no recourse against the borrower. So when the borrower is the IRA or the 401k, which retirement monies are federally protected, right? The lender can obviously seize or foreclose on the collateral property in the event of default, right? But they have no recourse against any of the assets of the borrower, who is that IRA or 401k, other than taking the property, okay? So just wanted to get some clarity on that. Now, let's talk a little bit about conventional versus private financing. Okay, so Fannie Mae and Freddie Mac are huge players in this dynamic between the two, right? So I like to always give a little story about the first rental property that I purchased. So this was 14, 15 years ago, very green in terms of knowledge on real estate, and I got my first 30-year fixed loan through Wells Fargo. Right, and I closed on it, and I was just on cloud nine, and I literally thought for years that, you know, I was getting my statement from Wells Fargo. I made my payment to Wells Fargo every month. I literally thought that Wells Fargo held my loan and collected the interest over the 30-year period, right? What I found out was that's completely untrue, and in less than 30 days from originating my loan, they sold it to Fannie Mae, right? They retained the servicing rights, which is why I keep making my payment there. But I describe that to you because it's the conventional lenders, the banks and the direct lenders like AmeriFirst Financial or whatnot, who have to abide by the guidelines set by Fannie or Freddie. Otherwise, if they don't, they cannot sell their loan that they originated in the secondary market to Fannie or Freddie. Right? So that's where private lending fills that cool niche, because private lenders have no intention of selling the loans that they originate to Fannie or Freddie. They want to collect the interest over time. So because of that, the private lender doesn't have to conform to the guidelines set by Fannie and Freddie. That's the primary difference. Okay, conventional financing. Let's talk specifics here. Right, so it's very related towards the borrower. Of course, they're going to look at the property, and of course, they're going to have an appraisal, but the bottom line is the focus is primarily on the borrower, which is completely opposite in the private lending sector, which we're going to get to. So we're talking about specifically, most people know credit score and history important, the employment type, and especially the history, right? People get caught up in not being able to qualify because they had a recent job change. Right? It's very tied into the amount of debt that you have and the income you make. And of course, there are specific guidelines for debt to income ratio, right? Also has to do with reserves, citizenship. That's a big one, right? A lot of foreign money pouring into the country. And so you have to be a U.S. citizen in order to get a conventional loan. And also it's that personal guarantee, which I put on here as a lot of people, you know, investors want to utilize an LLC or a corp or something in order to build their rental portfolio. You can't get, you know, banks don't make loans to entities. They only make loans to individuals because they need that personal guarantee. So additionally, regardless of the above, I mean, you could check out on all of those in bullet point 1, but there may be some other deal breakers out there that are, frankly, they're kind of ridiculous in some point. So short sale, foreclosure, and bankruptcy in certain periods of time. So if you have one of those issues on your credit history, doesn't matter how much cash you have in the bank, doesn't how much credit score you have today, it's just a straight deal breaker. The other two are very important, and I see them all the time, which are some of the primary reasons why folks come to us for private lending. The number of financed properties. So Marshall Reddick literally has thousands and thousands of investors building mega rental property portfolios, right? So getting to 10 rental properties is not a super difficult thing to do. I have more than 10. So no matter how good my credit is and how good my FICO score, my debt to income ratio, all of those items, I cannot qualify conventionally because I already have 10 financed properties. All right, so it immediately knocks me out of the realm for conventional financing, and I have to borrow privately or I have to simply pay cash. Third under here, but the second most common reason people use private financing is for low loan amounts. Okay, so banks and traditional lending institutions simply do not make loans under $50,000. There's no money in it for them, right? And I have a lot of sophisticated investors buying rental properties, nice rental properties, in the, let's say, $80,000 to $100,000 range, right? That buys you a lot in the Memphis market or in the Indianapolis market or in a market like Toledo, Ohio, et cetera, et cetera. So you can get 50% financing and still have a loan amount at sub $50,000, and you can't get it from a bank. So you come to somebody like Marshall Reddick who can set that up for you and still allow you to use leverage to continue to build your rental property portfolio. So in any case, on a conventional standpoint, having all of these guidelines allows them to reduce their risk, right? Because lending is all about analyzing and evaluating risk. So in turn, the borrower who goes conventional gets, like Daniel mentioned, the lowest down payment options. So today that's 20 or 25% for investors. I think there's actually a few programs out there where you can put down less as an investor, but then you're going to run into what they call PMI, which is private mortgage insurance, and you don't want that. That's just an added insurance that really is going to kill any type of cash flow that you could have. So really it's 20 to 25% minimum down for investor rental property. And then interest rates, they've ticked up quite a bit, so we're not really seeing anything in the 4s anymore. Really the standard you're going to be able to get from a bank is 5.25%. Which is not far off from Marshall Reddick's lowest interest rate program, which is 6.5%. We'll get into all the program details here shortly. So again, that's just a little overview on conventional, AKA conforming financing. Now let's compare that to private financing. All right, so the focus is absolutely away from the property, or excuse me, away from the borrower and primarily on the property. And it's on the property in terms of the equity position of the borrower on that particular property, which means the down payment, unless they already own the property, and therefore we're looking at how much equity they have versus the value of that property today. And it also has to have a very, very high sufficient cash flow. Now understand that this private financing that we launched was really geared towards 401k and IRA non-recourse borrowers, right? So we must have sufficient cash flow because in an IRA 401k situation, the amount of capital that you can contribute to that IRA or 401k is capped, right? So you can't get in a situation where you have a major problem in your rental property, you need capital to fix it up, right? So you're not able to collect rental income during that time, but you still have a mortgage payment. And what if you've already contributed your max that year to the IRA or 401k? So I tell you all of that because cash flow is huge, right? And I'm going to get into the debt coverage ratio that we require, which is one of our few qualifying criteria on the private financing side. Okay, so the lender's not necessarily concerned as they are on the conventional side with credit score, employment, citizenship, personal guarantee. Again, that's why our private programs are perfect for LLCs or corps. So if you're one of those folks who's got that LLC and is building your property rental portfolio inside of that, we lend to LLCs, corps, individuals, self-directed IRAs alike, okay? Short sale, foreclosure, bankruptcy are not deal breakers, and the number of financed properties that you own are not deal breakers. Okay, now I want to pause for a minute because I have a lot of people out there, I'm sure, that are considering what I said earlier about lending the money, right? Now, the private financing that we're doing, our borrowers are not subprime borrowers, right? Our down payment or equity requirement is so great that likely the client that's borrowing from us is a more sophisticated investor, right? Someone with a poor FICO or without good job history or that's got short sales, foreclosures, bankruptcy, or all those negative subprime type comments is in no way going to have the 40% down payment required to borrow private money from Marshall Reddick. And, you know, frankly, the bottom line is if they do have the 40%, no problem. I sleep extremely well at the end of the night in my lender's shoes, knowing that my loan to value is a maximum of 60%. Okay, so there are still some deal breakers for us, though, on the private finance. The borrower must have reserves, okay? And we'll get into that. They don't have to be a United States citizen, right? So if we have any foreign citizens on the call tonight, we can still get the loan done for you, but you must have a U.S. tax ID number, which means you must have like an LLC or corporation, a domestic LLC or corp, or you have to have an ITIN number, which is like a social security number, which means that you will be filing income tax in the United States, which means that the interest that you pay and that the lender receives can be reported on like Form 1099, right? And to you as the borrower on Form 1098. And then the cash flow, right? So we're going to require a heavy cash flow and basically force you as the borrower to be saving for maintenance and vacancy, because anyone who owns rental property knows that it's inevitable that you will have vacancy and that you will have maintenance. right? So we're going to force you from the lender's perspective to save that cash flow. Okay, and then again, it's about the risk and lowering the risk. So we minimize our risk since we're not concerned with credit, employment, citizenship, personal guarantees, that type of thing. It's the down payment, right? So really the qualification purposes for our private financing program is your down payment and your cash flow. If the property meets those criteria, you're approved. Okay, so again, it's 40% minimum down, which means 60% max loan to value, and the cash flow has to be 25%. So what I mean by that is your monthly principal, interest, taxes, and insurance can be no more than 75% of true market rent, as an independent Marshall Reddick underwriter will analyze and assign that market rent number. Okay, now we get a little bit higher interest rate than you will conventionally, right? So as Daniel mentioned before, if you can borrow conventionally, absolutely do it. Only go private when necessary. So our rates for you guys that are looking to borrow or for you guys looking to lend on the long-term program are going to range between 6.5 and 8.5%. So when is private financing appropriate? Well, number one, when the conventional lender can't help you, right? So there's a million scenarios out there that folks just hear no from the bank. Right? This is not for the subprime borrower, but it's rather for the investor, right, out there, like many of you, who are sick of hearing, I got too many financed properties, or my debt to income ratio is a little out of whack, right? Short sale, who doesn't have a short sale? After going through the 2008 era, it's very common and it doesn't affect credit like it once used to. Hey, sorry, I don't make loans under 50,000. I get calls from borrowers all the time saying I've got great credit, I've got cash, but I can't get a loan because I'm looking for a $45,000 or a $40,000 loan. Here's a good one that always makes you chuckle. You call the bank and you're like, hey, I've got an IRA or 401k, I'm looking for a non-recourse loan. And the response is, what's a non-recourse loan, right? That's the point in time when you just hang up and you call Marshall Reddick. The list goes on. Lastly, understand that customer service is extremely important. I was doing a presentation last night and we were talking with some investors about how, you know, it's so common. You go online, most people do, they check out a company's website. And for myself personally, I hate it when I'm looking for 15 to 20 minutes to try to find a phone number. When all I want to do is I want to pick up the phone, I want to talk to somebody, a warm somebody on the other hand to tell and explain things, how they work to me. That is something you'll absolutely get from Marshall Reddick, especially in the lending department that I run, okay? Customer service is of utmost importance right next to speed, okay? So not to knock on the banks and the traditional institutions that are out there, but if anyone's tried to do one lately, you understand that it doesn't get done quickly. Right? I don't know many banks ever that get your loan done in 45 days, let alone 30 days, right? So if you need speed, as most investors do, especially in a super competitive market that we're in right now, you need to be working with a lender who can get it done on time and done quickly. Additionally, it goes for banks and customer service. I mean, large institutions with bureaucracy, they're just not in the mode of customer service. Right, so oftentimes it's worth paying a little bit more for the loan and paying a little bit more on the interest rate if it gets you to your goals, which I think a lot of people are here tonight with goals of building large rental property portfolios. So the Marshall Reddick offers a couple of separate types of programs. Tonight we've been focusing more on the buy and hold, right? So these are going to be mid to long-term loans, permanent type loans for rental property, loan to value. These are going to be for really turnkey or rent-ready properties, properties that will appraise, right? Because the loan to value is based on the appraisal, not the purchase price. And we are up to a 30-year loan, right? That's kind of a niche program that Marshall Reddick runs. No other non-recourse lender that I'm aware of offers a 30-year fully fixed program. We also have a completely separate program from that, which is our fix and flip or our fix and refi program. So we're talking about ultra short-term loans at very high loan to values, 100% or more LTV, which will allow people to buy distressed properties. Primarily it's fix and flip groups that are using these, and they're very sophisticated groups. okay, not the weekend warrior. Again, 12 months is going to be the maximum term. All of our loans are going to be written on a 12-month promissory note. So I've got an asterisk there by the fix and refi, also known as BRRRR, for all of those bigger pockets folks out there. Right? So there's a lot of people who desire to try to buy distressed, you know, maybe use a hard money loan to do that, rehab the property, then rent it out, and then refinance it with a private or a conventional loan if you can do it, and then repeat that. So the goal in that is to get into rental property for much less down than the traditional 20 or 25% with a conventional loan, or 40% with a private loan. We'll talk a little bit more about that. I have a case study further along in the presentation. So here is the rate card for our long-term money. Okay, so we offer 4 distinct programs. You can see them on the screen now, right? 30 or 15-year amortizations, no option for interest only. Okay, the lowest interest rate program at 6.5%. Now understand the payment column on here is based on the $100,000 loan amount. So $100,000 loan amount at these interest rates on these programs will translate into those payment amounts there so that you can easily kind of run the numbers. However, if you'd like to run the numbers with me or one of my underwriters, just give us a call. We're happy to spend the time with you, walk you through our loan application, and answer any questions that you have. Also wanted to point out on the screen too, some important items there in the terms factor, right? Number one, being the 60% loan to value maximum, no wiggle room on this. None of this is negotiable, okay? And in addition, there's a 3-year interest guarantee. So these are not going to be used for flippers or for wholesalers or anything of the sort. Now, let's talk about the details, and we'll talk about that interest guarantee so that everyone's clear on exactly what that means. Okay, so we talked about the LTV. I think everyone's probably pretty clear on that. Strong cash flow. So let's talk the fact that we are going to do an independent analysis on the rent of your investment property that you own or that you're looking to buy. And we are going to cap your loan amount so that your PITI is no more than 70% of market rent. So I've got a little screen clip there that shows very simply, easy numbers, right? If you are a property rents for $1,000, your maximum monthly PITI and homeowners association, if applicable, would be $750. Again, forcing you to have a super positive cash flow so that you don't get into any trouble. We talked about how we have that 30-year fixed option, and all the programs are amortized. Minimum loan amount going to be $25,000, and also note, we'll get into loan servicing here shortly, but loan amounts from the borrower's perspective under $75,000 will require the borrower to cover the loan servicing fee on behalf of the lender. Okay, the loan servicing fee about $15 a month. And that will be added into your monthly payment and written into the promissory note. Not the end of the world, but do understand it just affects the lender's yield too greatly for low loan amounts, right? So if the lender is looking at funding your loan, right, and you want that 6.5% 5-year balloon option, and your loan amount, let's say, is $40,000, your payment's literally going to be like $200 a month. So if I take $15 out of that $200 a month payment to the lender, their yield goes down from now 6.5 to more like 4.5 or 4.75%, and they're simply going to ignore and not fund your loan, which you do not want to happen. All right, and again, I mentioned purchase refinance or cash out refinance. And point out, I discussed a little bit earlier about a popular program about people buying rental properties cash, fixing them up, and then wanting to borrow against the equity to go and do it again. That's a real niche program that we offer, where a lot of non-recourse lenders that are out there will not refinance the property based on the current market value, but rather the purchase price that you paid. Now, for those sophisticated investors out there who picked up property, let's say in Vegas or in Phoenix, or in one of those boom or bust markets after the crash happened. I mean, I got folks that bought property in Phoenix for literally like $85,000, $90,000, right, that are worth $300,000 today, 10 years later, of course. Well, the NASBs of the world are going to look at that loan and they're going to say, I'm willing to do a cash out refinance for you, but I'm only willing to lend you 60% of what you paid for it, not 60% of what it's worth today on a traditional third-party appraisal. Our guidelines state that we will go up to the property's current market value today as set by that appraisal. So make sure that you understand that. Very important. Okay, the buy and hold program, we talked about the 3-year interest guarantee on our loans, right? So what does that mean? That means that, and I've got an amortization table on the screen. So whatever the specific terms are of the loan that you desire, right, you'll have a monthly payment that consists of interest and principal. So the cumulative amount of interest paid at that regularly scheduled monthly payment over 36 months will be your interest guarantee. So on this sample amortization schedule, which someone's getting a $41,700 loan amount, they're getting a 30-year fixed loan with us that carries an 8.5% interest rate. Their monthly payment's $320.64 per month. Over 36 months, they will have paid a cumulative amount of interest of $10,511.17. So as the borrower, if this is your loan and you desire at some point in time, let's say at month 24, to pay off this loan, you're certainly welcome to do so. But at month 24, you've only paid approximately $7,000 in interest. So to get out of this, you're going to have to pay the difference between the guarantee and the interest cumulative you paid thus far. Okay, moving along. The reserves we require. So we're going to want to see a bank statement or your IRA statement if you're using self-directed IRA to buy. 6 months worth of PITI or a minimum of $3,500. Again, sometimes the loan amounts we're doing are $25,000, $35,000, $45,000, and 6 months PITI could literally be like $1,000 bucks. So we're going to require to see a minimum of $3,500. We will not impound or have an escrow account unless you want to pay for it. So the $15 monthly servicing fee I talked about before, that's just the basic servicing fee, right? That will not cover an escrow or an impound account. If you want that, the lender doesn't need that. If you want that as the borrower, you can opt to pay for it. It'll be an additional $15 per month for a total servicing cost of $30. Marshall Reddick offers straightforward pricing. You don't see that a lot, right? What you usually see with most institutional lenders is the teaser 1% a loan origination fee, and then they don't show you the processing, underwriting, and other hidden junk fees. Junk fees are bad. Let's just be transparent. So from a Marshall Reddick's perspective, we lump everything into 2 categories, right? You're going to have your 3% loan origination fee, right? So that's 3% of the loan, and then you're going to have a doc prep, flood certification that any lender is going to make you get to make sure that your property is not in the flood zone, and we're going to have a tax service fee, which is simply a third-party service that ensures that you as the borrower are making your property tax payments on an ongoing basis. Straightforward pricing, important. Let's talk about third-party costs. Okay, so in addition to the costs that you'll pay for the loan as you would for any institutional lender out there, right, you're going to have your third-party costs. So we're going to have an appraisal, right? So that runs today. We use an appraisal management company, just like a traditional lender. Appraisal is not our choice. We don't know what the cost is going to be. It's going to run you between $500 and $650, right? Unless you're multifamily, then it goes up from there. Escrow, title, recording, etc. Those all vary, and those are all third-party costs. The borrower bears all costs just as normal. Okay, so time frames, right? So 21 to 30 days were pretty quick, right? And that's again for our buy and hold, our long-term permanent financing. I don't really get a loan done in 21 days or less. So I would consider us extremely fast. And if there's a delay beyond that, it's not going to be because of Marshall Reddick, right? It's going to be because you or the custodian are dragging your feet or not getting back to us with information that we need, or the appraiser is super backed up. In some markets today, very competitive markets, I'm seeing like 14, even 17 or 20 days to get an appraisal back from the day that it was ordered. We try to avoid that, and usually we're closing these loans in about 21 to 30 days. Third-party servicing. So we have relationships with Superior Loan Servicing as well as Note Servicing Center. We're open to utilizing other loan servicers, but those are we get preferential treatment from these two. All right, so we talked about the programs and rates on the rate sheet, but here they are again. And I wanted to show this briefly so that we could talk about the balloon programs. I'm sure everyone's clear on what a 15-year fixed or a 30-year fixed program looks like, but the 5 and 10-year balloons, those are both fixed rate programs also, right? So you're not going to have a change in your monthly payment. It's just at the 5-year mark, the remaining principal balance needs to be paid off in full. Or at the 10-year mark, if you do the 10-year balloon, the principal amount at that time needs to be paid off. That means that the lender's obligation to you as the borrower is no more than 5 or 10 years, depending on the respective program. Now, how do you pay that off? Well, you either have to refinance to pay off, you have to sell the property to pay off, or you have to have sufficient cash to simply write a check and pay off the loan. Okay? All right, so let's look at a couple examples. These would be right from the Marshall Reddick website so that you can see how the private programs tie into and would work for a scenario, right? Because I know we've got some sophisticated folks. We also have some unsophisticated folks or some first timers who are looking into this. So here is a small property in a market I personally like, Oak Grove, Kentucky, about 45 minutes northwest of Nashville, right on the Kentucky-Tennessee border. The purchase price here is $69,500, and this program would be the 30-year fixed Marshall Reddick financing, which carries an interest rate of 8.5%. So this is a $320.64 a month payment. All said and done, including the heavy maintenance and vacancy factor, you're still able to make a super solid return. Let's look at the same example, but this time let's look at it with a 10-year balloon as opposed to the 30-year fixed, right? So the 10-year balloon carries a 7.5% interest rate, so that payment drops, what, roughly $30 a month, just boosting your cash flow. Again, these are considering a 40% down payment, which would be our minimum. All right, so let's move on now. That was the long-term, the permanent, like the buy and hold financing, but there's a lot of people on here that I'm sure are interested in learning a little bit about our short-term programs. Okay, so here's my short-term rate sheet, right? So these again are for fix and flip or fix and refi folks. The two programs I've got the box around now, the 9 and 10% programs, so we will lend up to 100% of the purchase price in both of these programs, but no more than the purchase price. It has to be less than 70% of the after renovation value, but we will lend up to 100% LTV. The difference between the 9 and 10% programs is that the 9% program requires monthly payments, right? The 10 and 12% programs do not require monthly payments. So the payments, so the interest will accrue throughout the term of your 12-month loan, right? But you'll pay it back all in one lump sum, generally at the resale of the property or the refinance of the property, in full, one lump sum of principal and interest. So that is utilized by a lot of my sophisticated fix and flip groups around the country. Okay, so I've got a team in Memphis and I've got a team in Cape Coral and all those types of areas, right? So if you've got experience and you could benefit from these programs, I'm happy to speak with you. Okay, as we mentioned on the long term, there is also an interest guarantee on these fix and flip programs, and that's 3 months. Okay, so again, that's a specific amount that must be paid. You're welcome to pay the loan off. Let's say if you decide to wholesale the property, right? You've only held the loan for 30 days. You're welcome to do so, but you're going to owe 90 days worth of interest in order to effectively pay off that loan. Okay, so the details on the fix and flip or refi program, 70% max loan amount based on the after renovation value. So that's the forward-looking value. Now, I have a couple of in-house underwriters who is their job specifically to look at the property like an appraiser would and look at the scope of work, what's going to be done to that distressed property, right? And we determine the after renovation value, not you as the borrower, okay? And in that case, that after renovation value will drive the maximum loan amount, no more than 70%. No appraisal, we call it a BPO, and again, that's done here in-house at Marshall Reddick in our Newport Beach office. Maximum 12-month term, you must have a crystal clear exit strategy, right? So if your exit strategy is to sell, okay, great, right? I need to know that that's going to be a possibility. If your exit strategy is to refinance, okay, great. I'm going to want to know who you're going to refinance with. If it's going conventional, I'm going to want to see a pre-approval letter. I'm going to want to talk to that lender. I'm going to want to make sure it's going to happen. The last thing I want to do is put one of my clients' money in a short-term loan with you, and then you decide, oh, well, I actually can't qualify, and now we're not crystal clear exit strategy. So we're going to kind of dive into that on this side. Minimum loan amount, 30 grand. And the minimums really come in is because we just don't really want to lend against really not good property or property that's not in a good location. It's probably not a good investment for you either as the borrower. And again, we talked about the 3-month interest guarantee. Okay, so we do have a non-recourse option for the fix and flip or refi. Not a lot of folks out there offering. So this is a case-by-case situation. We may ask for a little bit more of a down payment or a lower LTV than 70% against that after renovation value, but I will talk to you if you want to use your IRA or 401k to flip property or to buy something distressed, then refinance out and hold it. Please, no weekend warriors and no HGTV dreamers, right? You'd be surprised. It's been glamorized and posterized on HGTV. Everyone and their mom wants to flip property. Marshall Reddick short-term programs, we do not lend to those folks. Okay, so you must have experience, or I'm going to require a heavy down payment. Okay, straightforward pricing again, 2% on the short term, and again, $275 doc prep fee. We do not charge the tax certification or the tax monitoring fee as we do in the long term. No other processing, underwriting, or other hidden fees. Your closing costs are going to be the same, and you bear those, right? So escrow, title, recording all vary by the escrow company and the location. If you're curious of what those are, we're always happy to call and establish, a relationship and find out what those will be if you need to know before you fund or before we get to the closing table. So anyone listening tonight that knows someone who could benefit from these programs or someone who's got good experience and is looking for a good private money or a good hard money lender, let us know about it, right? Ask us about our referral programs. So time frames. We are going to be very, very fast. And this is just absolutely something that's necessary in the short-term program. I mean, it's so competitive out there. I'm looking at buying a couple of properties in the Indianapolis market right now, and it's just like the wholesalers are moving the properties so quickly. If I can't close, I mean, literally in like 2, 3, 5, 6, 10 days, the deal's gone and sold 3 times over. And a lot of times it's to somebody with cash or a really good private lender in their back pocket like Marshall Reddick. So again, the speed's largely based on you as well as escrow. So I'm quite positive that if you're one of my borrowers in this program, you will not be waiting on us to fund. You will be waiting on somebody else. And since usually there's not monthly payments, or if there are monthly payments, they're interest-only payments in the short-term program, there will be no loan servicer, so you will not have to pay a loan servicing fee. Marshall Reddick will act as and function as your loan servicer during that 12-month period. Now, I did want to specify that in these programs, just because we're writing on a 12-month promissory note doesn't mean you keep the loan for 12 months. Right? You're welcome to pay it off at any time, subject to that 90-day interest guarantee. And the interest is calculated simply as any lender would, simple interest calculated based on a per diem and the number of days that the loan was outstanding. All right, so let's do a little case study, again, for those BRRR advocates, right? So here's a nice property, again, a market that I focus a lot on in Oak Grove, Kentucky. This is an $85,000 purchase or value, and this is what the pro forma would look like for buying it with a conventional loan at 20% down. Now, we're moving pretty quickly in this, and there's a lot of information, so if anybody would like the PowerPoint after this, feel free to send myself or Daniel an email. We'd be more than happy to send you the slides. we're also going to be recording the presentation, and so that will be available and sent out to you via email tomorrow. All right, so conventional pro forma, 20% down. You see how the numbers shake out. So now with that in mind, what if I could tell you or show you how you could buy this instead with only a total investment of just over 2,500 bucks, right? Here I'm back on it. If you buy this in a straight up fashion, you pay $85,000 for this. You're going to be looking at a total outlay of cash with 20% down at roughly $20,500. But I'm going to show you now, if you were a BRRRR borrower or investor, that you could do this for literally $2,680 out of pocket. And here's how it works. Right, so this property is a 3-2, built 97. It was a VA foreclosure. We actually purchased this property, and we do this. Okay, so the purchase price was $36,000, right? The after renovation value, as underwritten by Marshall Reddick underwriter, $85 grand, right? So we believe that it will appraise for $85,000. The Marshall Reddick loan then is established at 70% of that number, which would be $59,500 maximum, right? So the purchase price that we were paying for the property, $36,000, right? We wholesaled this property off, or you're buying it in a hypothetical situation from a wholesaler, right? And you're paying a markup, $10,000, right? So then your effective purchase price and your closing costs and your loan costs and your renovation, in this case, we're saying that property needed 15 grand worth of work, you were all in for $63,460, all right? That in mind, your total out of pocket or your initial out of pocket with your hard money loan at 70% of that after repair value is just under $4,000. Now, let's fast forward 6 months. You've got the property nicely renovated. You've got it stabilized with the tenant paying market rent, and you've waited your 6-month seasoning period to be able to go to AmeriFirst Financial or Bank of America or another traditional conventional lender and refinance this property at 80% of appraised value, as we just saw in the pro forma I showed on the prior screen. So 80% of the $85,000 appraisal, $68,000 loan amount, okay? But of course you have to pay for that refinance loan, and that costs you about $3,500, again, straight off the pro forma I just showed. So the proceeds net of that refinance are $64,500. And again, looking to the left-hand side of the screen, your all-in total out of pocket was $63,460. Now, factor in the interest that you owe to the private lender who lent you the $59,500 loan amount. Your total payoff, again, including interest, is going to be $63,200, which means that after your proceeds of your refinance, and that refinance, you're actually getting a little over $1,000 back. Compare that with your initial out of pocket at $3,960, means your all-in total investment in this scenario is $2,680. So pretty cool. Now that's not super easy to do. There's a lot of moving parts, but it can be done. And trust me, sophisticated investors out there are doing it, and they're utilizing private financing with Marshall Reddick. Okay, so moving along, how does the private financing work? All right, you qualify, we talked about this, we're gonna take a loan application from you, we're gonna verify down payment, closing costs, and reserves, we're gonna need to see your tax identification, and we're gonna verify and do that analysis on the rent and therefore the property cash flow, right? There's gonna be no credit check in either program, there's going to be no employment verification, and there's gonna be no debt to income ratio. Right? Your down payment and the property's cash flow, at least in the permanent buy and hold financing, will be done based on your down payment and your cash flow. So here's what my loan app looks like. Very simple, not like the standard 1003 that you're going to get. I mean, literally was like created 50 years ago and is such super small print and takes forever to figure out and doesn't make any sense. You're going to get this from us, super simple, take you 5 or 10 minutes to fill out. And here's what my non-recourse one looks like, very similar. Nonetheless, this is going to be very quick, and this is going to allow me to provide you with a pre-approval letter. Bingo, you're going to need that to start making serious offers. And those of you who are working with Daniel or one of the real estate advisors or realtors in my office, you're going to know that a pre-approval letter is like gold. You can't do anything without it. So as we talked before, who lends the money in this program that we're talking about? It's other Marshall Reddick clients, right? So we've got a lengthy list of clients and investors who prefer to lend and collect a monthly interest check as opposed to buy and own the property with the premise of collecting a monthly rent check, right? So just know that Marshall Reddick is not lending the money, right? It's a private investor, and we hit the numbers every single time. We're not a huge shop. We're currently funding an average about 30 loans a month, but we're a very boutique, very customer service oriented lending institution. So the website, okay, this is what our homepage looks like today. For those of you who want to buy rental property and borrow, you're going to go to the properties section. If those of you who want to look at the mortgages that are available for funding, right, you're going to go to the mortgages section of our website that's there under the invest tab. So marshallreddick.com/properties or marshallreddick.com/mortgages. Coming soon, awesome, is going to be this borrow tab. I hope to have this up before the end of the year. It's going to be a game changer. The loan application is going to be right here. We're going to be able to pull all of the data from you, and this is going to only increase the customer service experience and the speed in which we can fund your loan. marshallreddick.com/borrow. Look for this on the website coming soon. All right, so let's talk a little bit about our process flow, and then we're going to wrap this up, and I'm going to let you guys get on your way. So obviously, we're going to take that loan application, verify your documentation and proof of funds before we provide you with that pre-approval letter. Once you have that pre-approval letter, you're in the game. After that, you know, you're making offers and you're under contract. And this flow works just like it will with any other type of traditional lending institution. We're just faster. Escrow will be opened after you're under contract. You're going to put in your earnest money. You're going to have your inspection, title work, appraisal, all of that. We're going to be with you and your real estate agent or real estate advisor every step of the way. Next, we're going to move into loan documents. You get to approve and review your loan documents. We're going to help you in terms of your insurance. We don't have to help you, but we are going to need to be involved because we are going to add the lender as the mortgagee on your insurance policy, just like a bank would, right? That way the lender gets a copy of any insurance-related correspondence, such as a cancellation or a non-payment of premium, or if you try to remove the lender as mortgagee, right? The insurance company is required to issue that notice. Then we're going to move ultimately to closing, funding, and the setup of your loan servicing. Right, at this point in time, you're going to be working with one of our transaction coordinators here, and you're going to be on your way, right? Your loan's going to be set up. You're going to have seamless move into the monthly payments, and it's going to be just like it would or better with a bank. Okay, a little bit more about loan servicing, right? So this is simply a third party. There's hundreds of them out there, just like there's hundreds of self-directed IRA custodians, right? But the loan servicer is a third party who handles all correspondence between borrower and lender. Borrower doesn't talk to lender. Lender doesn't want to talk to borrower. You know, consider this a property manager for your loan, just like those rental property owners that are out there. I mean, you don't want to talk to your tenant. You don't get calls in the middle of the night about the backed up toilet. You hire a property manager. Same thing for your loan, right? So the loan servicer is going to have a cool website where you're going to be able to set up monthly automatic payments. They answer any questions that you have. They handle all the year-end paperwork like the 1098, the 1099. They do all the accounting. They handle the payoffs. It's really a great service for a very low cost. Again, for loan amounts under $75,000, the loan servicing fee will be paid by the borrower, right? If it's over 75, it will be a lender paid service, which is usually in a traditional type sense, loan servicing is a lender paid expense. I went over earlier why loan amounts under payment. Okay, so we're just about finished. We're just going to have another quick poll, get that launched, and get some more feedback from you guys. So we're going to launch that poll, and the question is, how likely are you to use private financing in the next 12 months? So I would super appreciate everyone's response. Won't keep it up there too long. And I am running the webinar by myself tonight, so I'm not going to be able to answer too many questions. I think we're running a little bit late on time as well. So we will get back to you. Daniel will be calling each and every one of you, and we will specifically address one-on-one over email or over the telephone any questions that you do have. Okay, so just a couple more seconds, and we're going to close the poll. All right, thank you so much for your response. So we're closing it, and let's go ahead and share it. Okay, so looks like we've got some questions about how the private financing works, right? 50% saying, I'm potentially interested, but I need a little more information. Great, we want to speak with you, right? For the 25% likely, but I'm shopping lenders now. Cool, I encourage you to do that. I know I shop lenders whenever I'm looking at my next investment purchase. Make sure that you remember though, it's not all about interest rate and cost, right? Pull your hair out sometimes of that customer service and call the bank or call NASB, and it's like, how many times are they going to pass you around to somebody else before someone who answers the phone who actually knows what they're talking about? Unlikely, and how do I learn more about becoming a private lender? Cool, we want to talk to you guys as well. So thanks again for participating. We'll move on. Okay. So that's going to wrap our presentation for tonight. Super happy that I was able to be here with all of you. I hope that you all took away some vital information, that you understand that Marshall Reddick is a private lender who offers long-term buy and hold permanent financing that can help you in terms of building your rental property portfolio. For those who are a little bit more sophisticated or for who have experience and are looking to do something on the short term, right? Happy to speak with you as well, and we service that type of product also. And all of those of you who, you'd be surprised, people set up a self-directed retirement account and they think that their only option for real estate investment is to buy property and collect rent. Understand, a lot of those folks end up being private lenders in my program and realize that, you know, collecting a specified amount of interest at, you know, a 6, 7, 8% yield is certainly not a bad idea. So again, thank you all for being here tonight. Hope everyone has a wonderful evening, and we'll look forward to seeing you on the next Marshall Reddick event. Thank you.